Hospitality financial accounting is about understanding how money actually moves through hotels, restaurants, resorts, and other service businesses. This video, we're going to break down accounting concepts in practical terms, focused on how managers use financial information to make decisions, control costs, and keep operations profitable. You don't need to be an accountant, but you do need to understand the language of money. Bookkeeping and accounting are related, but they are not the same thing. Bookkeeping is the process of recording daily transactions, sales, payroll, invoices, and receipts. It's about capturing what happened. Accounting takes that information and analyzes it. Accounting turns that raw data into financial statements, insights, forecasts, and decisions. In hospitality specifically, bookkeeping records last night's room revenue. Accounting tells us whether pricing, labor, or occupancy levels are sustainable. There are several branches of accounting, and hospitality operations uses all of them. Financial accounting focuses on external reporting for owners, investors, and lenders. Cost accounting tracks food cost, beverage cost, labor percentages, and waste. Managerial accounting supports internal decision making, such as staffing, pricing, and budgeting. Tax accounting ensures compliance with sales tax, occupancy tax, and payroll tax. Auditing verifies accuracy, prevents fraud, and ensures controls are actually working. Most hospitality managers operate heavily in cost and managerial accounting, even if they don't exactly call it that. GAAP, which stands for Generally Accepted Accounting Principles. These are standardized rules that govern how financial information is recorded and reported. GAAP ensures consistency, accuracy, transparency, and comparability across businesses. For hospitality organizations, GAAP matters because lenders, investors, and corporate owners rely on a standardized financial statement. If your numbers do not follow GAAP, they can't fully be trusted or compared. Accounting is built on a set of foundational principles. These principles guide how transactions are recorded and reported. They exist to ensure fairness, reliability, and clarity in financial information. The cost principle requires assets to be recorded at the original purchase price. The business entity principle separates the business's finances from the owner's personal finances. Objective evidence means transactions must be supported by documentation like receipts or POS reports. POS, point of sale. Full disclosure requires reporting anything that could impact financial decisions, such as leases or legal issues. Consistency means using the same accounting methods period after period. The matching principle requires expenses to be recorded in the same period as the revenue they generate. Conservatism encourages caution, anticipating losses but not overstating gains. Materiality focuses on information that actually impacts decisions. Revenue recognition requires revenue to be recorded when it is earned, not when cash is received. The balance sheet provides a snapshot of the business at a single point in time. It shows what the business owns, what it owns, and what remains for the owner. The balance sheet follows the equation of assets equal liabilities plus owner's equity. Assets include things like cash, inventory, equipment, and property. Liabilities are loans, accounts payable, or accrued payroll. Owner's equity represents the owner's investment and retained earnings. If the balance sheet doesn't balance, something's wrong. The income statement, which can also be called a profit and loss statement, shows performance over a period of time. It summarizes revenue earned and expenses incurred. In hospitality, revenue includes room sales, food and beverage, events, and ancillary services. Expenses include labor, food cost, utilities, marketing, and operating supplies. The result is your net income or net loss. This statement tells managers whether operations are profitable, but not whether there is specifically cash on hand. The statement of cash flow tracks actual cash moving in and out of the business. Cash inflows include guest payments, deposits, and financing. Cash outflows would be payroll, vendor payments, rent, or debt services. This statement is critical because profit does not equal cash. Many hospitality businesses fail not because they aren't profitable, it's because they run out of cash. Cash accounting records transactions when cash changes hands. Accrual accounting records transactions when revenue is earned or expenses are incurred. Hospitality businesses use accrual accounting because it provides a more accurate view of performance. For example, a guest may pay today for a future stay, but the revenue is recognized when that stay occurs. Accrual accounting smooths seasonal fluctuations and supports better decision making. All the financial statements are not separate, they are connected. The income statement shows profit, which increases owner's equity on the balance sheet. Cash flow shows whether profits are turning into usable cash. The balance sheet reflects the cumulative effect of all business activity. Understanding how these reports interact gives managers a complete financial picture. As you see on this image, the opening balance sheet helps the statement of retained earnings. The income statement also helps that statement of retained earnings, and it helps the statement of cash flow. The opening balance sheet also goes into the statement of cash flow, and that statement of retained earnings goes into the closing balance sheet. They're all interconnected. And at the bottom, I have the accounting equation. At the core of accounting, this equation is fundamental. Assets equal liabilities plus owner's equity. Every transaction affects at least two accounts. And this balance is maintained through the system of debits and credits. Debits and credits are simply directional tools used to keep the accounting equation balanced. Assets increase with debits and decrease with credits. Liabilities and equity increase with credits and decrease with debits. Every transaction must include at least one debit and one credit. This helps keep the balance. Debits and credits are not good or bad. They are merely mechanical rules. Let's look at a simple hospitality transaction. A guest pays $200 for a room. Cash increases as an asset. This is recorded as a debit. Revenue increases owner's equity, which is recorded as a credit. The accounting equation remains balanced and the transaction is complete. Hospitality leaders must understand accounting to help control labor, manage food costs, and price services correctly. Financial literacy allows managers to interpret reports, spot problems early, and communicate effectively with owners and lenders. Accounting knowledge turns managers into key strategic leaders rather than reactive operators. Accounting is not just about compliance. It helps drive decisions. Financial statements are interconnected and must be read together. Cash flow helps keep businesses alive. The accounting equation must always be balanced. Hospitality leaders who understand accounting are better equipped to run profitable, sustained operations. Thank you for watching this video this week. Please like and subscribe. I've also attached the reference Hospitality Industry Financial Accounting. I use this in my UNLV, University of Las Vegas, Nevada, hospitality courses. Thank you.